You've spent decades building your retirement portfolio, and now you're entering that consumption phase of your life, where your portfolio is finally asked to work for you. Whether you're entering FIRE or traditional retirement, the question is, do you stay invested in a portfolio focused on growth, or do you embrace an income-focused strategy? In this video, I'll show you why high yield income consistently wins, delivering sustainable monthly cash flows without eroding your wealth. So stick with me through this video. I'm going to walk you through the real numbers, the real scenarios, and show you exactly why income-focused strategies win during the consumption phase of your life. So let's get into it. Hello, everybody. My name's Perry. Welcome to the PIIverse. And this is going to be a follow-up. I call it round 2 follow-up response, because this video that I'm doing today is following up on a video that I did about 10 days ago, which sparked a lot of debate and a lot of dialogue. I'm going to show you what that video was for those that did not see that video and are wondering, why am I doing this video? This was the video here. I've just showed it to you right here to my side. It was this title, and it basically did a head-to-head battle between 3 covered call ETFs in different scenarios. HOOY versus its underlying HOOD, which is Robinhood. CONY, which was a heavy eroding covered call ETF to show the metrics of a covered call ETF that's in the process, that's currently in a state of erosion, going after its underlying coin, which is Coinbase. And finally, the last scenario was one of the more conservative covered call ETFs, HYLD, going after a growth-based ETF that is very similar in structure to the underlying of HYLD, and that is VSP. In this video, I showed time and time again under various scenarios, no withdrawals, withdrawals using the 4% rule, withdrawals using the maximum that the covered call ETF can sustain at being a level sustainability, and also added things such as if you added market correction, like a 20% market correction. And I did it for every one of those 3 scenarios. And I'm going to leave the link right up here. You can see it right here. Well, right here. I'm going to show a link there. Click on it. And if you want to watch this previous video before watching this one, it might be good because you're going to see this similar spreadsheet, but I've done some major enhancements of it since then, because this is the way to help explain my point better. Watch it and then come back. If you've already watched it, so what we're going to do is, I basically was inspired because there was a lot of debate brought up after this video, where there's a small consortium of growth purists that totally think covered call ETFs are like the scourge of the earth. They don't believe that they have any value whatsoever, that a growth stock will always beat a covered call ETF based strategy every time. And some of the purists were debating with me saying, Perry, your video didn't show anything, because at the end of the day, my ROI is better than your ROI. And it's like, they just don't get it. So I turned around and I said to myself, maybe I didn't actually explain it even clear enough. And if he doesn't understand it, maybe there's people on the fence that might actually start believing him. So I needed to change my video and change my spreadsheet so I can better explain to you why his argument is wrong. So stick with me here. We're going to do a spreadsheet. But before I do that, I got to make sure I first do my disclaimer. I'm not a certified investment or tax expert. I'm just a retail investor sharing my journey and experiences along the way. The content and opinions expressed in this video are for education and entertainment only. Do your own research. Consider expert advice before making any investment decisions. Okay, then. So I'm going to talk about the first thing. There was one point made by one of the one of the people that were debating with me, and I'm going to put that one to bed pretty quickly. So let's get over to my spreadsheet. And for those that watch it, you're going to see it's going to have a major change. I've done some huge overhauls on this spreadsheet. I'm going to go to this one first. So one of the debates that was brought up in the Blossom community was by a person that said, "Well, Perry, you're comparing HYLD." And by the way, I'm going to correct a mistake I made in the previous video where I said that HYLD and VSP are unhedged ETFs. They're actually hedged ETFs, but they were both are hedged ETFs. So please forgive me on that one. But his argument is that because HYLD uses leverage, then I should have picked VSP. I shouldn't have picked VSP because it doesn't use leverage. So in order to have a fair comparison, I should have used a growth ETF that actually uses leverage. And my argument to that is no way. That does not make sense whatsoever. The whole concept of the comparison between the covered call ETF and its underlying is that you were comparing against the underlying. Now, HYLD does not use VSP. It uses several of their own covered call ETFs underneath them, but none of those have leverage. So basically, I'm comparing a set of underlyings in HYLD that doesn't use underlyings or does not use leverage. Therefore, I can't pick something other than VSP that has leverage because that wouldn't be an apples to apples comparison. And before somebody asks, well, Perry, why didn't you just use the actual underlyings of HYLD? The reason I didn't do it is because in order to do that comparison, the underlyings in HYLD, there's several of them. They have about 5 or 6 of them. And for me to do a comparison, I needed to have a single versus a single. And VSP basically simulates or emulates the S&P. And so does the underlyings under HYLD. Again, not perfect, but they both are trying to emulate the S&P environment. Therefore, VSP is often used as the comparison on covered call versus an underlying. It's used quite often. And that's why I used VSP, not anything else. And that's why I didn't use the underlyings directly under HYLD, because it would have been way too hard to actually do a head-to-head comparison 1 versus 5 or 6 or 7. So this was why I did that. But generally, that is my first argument. So that puts that one to bed. So I'm going to go back now and I'm going to start right from the beginning on the second argument. And this is the argument. It's going to be, we're back and forth, but what you get a lot from this small consortium of growth purists that don't believe that income portfolios or covered call portfolios really will compete against growth. They always use this argument that the underlying will always have a higher ROI than the covered call over top of it. So for example, I'm going to give you a good example here in this spreadsheet, and I hope this is big enough. I apologize for those that are trying to watch this on their phone. This is a very large spreadsheet. I've got it as big as I can. I'll make it a little bit bigger, and I'm going to zoom in and out just to help. But I'm just trying to get over here. So the one argument they keep saying, and he actually wanted to bet me money on this, which was silly because it's like taking a guy to a hockey game and he's trying to bet on you on baseball scores, on baseball metrics, saying, or football metrics. Well, this guy's going to have a touchdown before that. It's like, we're not talking football here. We're talking hockey. So he was basically saying, at the end of the day, I'm going to bet you that HOOD will always have a higher ROI than HOOY. And here you turn around and says, after 1 year of metrics of consumption, it doesn't matter what I do. Basically, the per share ROI of HOOD is 147% versus HOOY, the covered call ETF, was 133%. He's right, but no one's debating that. That was like him saying, I'll bet you that the sky is blue. No one was debating that the sky was blue. He's basically not looking at the actual argument on the table, which is more about how does your whole collection or your whole holding of HOOD, let's say you have 1,000 shares of HOOD versus 1,000 shares of HOOY, whatever it is, which one is going to survive after 20, 30 years at different withdrawal rates? The per share ROI means nothing, because as soon as you sell a share, your ROI on a sold share after it's sold is 0 because you don't own it anymore. So you have 0 ROI on a share that's sold. And that's the part I could not get through to this person. I'm hoping that others of you that are actually have a little bit more common sense here, or can see the forest for the trees, can see what I'm trying to talk about here. So I'm trying to switch over here, and I don't know why. I have to actually make it smaller yet. Sorry that, people. So here it is. So what I'm going to do is I'm going to show you why a per share ROI of an underlying does not matter when you're talking about a portfolio that's got to basically feed you, pay you out on a monthly basis for the rest of your life. So what I've done, if you've watched the first video, you've noticed that this area here was pretty small. I've decided to say, hey, you know what? If you go to a bank and talk to an investment manager or advisor or whichever you want to talk about, and they basically say, hey, I'm going to retire. I'm age 60. I'm going to retire. Here's my portfolio. Help me work out a strategy where my portfolio will pay me what I need to pay, what I need to receive in order to live for the next 30 years. Well, until age 90. So basically, a lot of investment advisors say, I got to make sure you have a portfolio that will pay you what you need to pay so you can enjoy your retirement up to age 90. Now, if that's the case, and let's assume I'm 60, I'm 62, but if you assume I'm 60, that means from age 60 to age 90, right here, 30 years. So I have to have a portfolio that will survive and pay me what I need to pay me consistently and sustainably for the next 30 years. Okay, that's what I'm going to do. Assuming that both myself and my wife pass away at age 30. 90 is about the age people use when they do these calculations for retirement meltdown. Now, in a strategy where you talk to an investment advisor and stuff like that, and they do the retirement planning for you, they call it a meltdown strategy or a deaccumulation strategy or basically a de-wealthing. Doesn't matter what you're talking about. When you're talking about a growth portfolio, you're talking about eroding your portfolio, selling the wealth so that you can convert it to cash so that it can pay you, so you can enjoy your trips to Europe, that you can pay your bills, you can pay your gas, your insurance, whatever. So at the end of the day, in a growth portfolio, whenever you talk to them, you're talking about de-wealthing or melting down your portfolio at a pace that will survive at least 30 years. So of course, you can't turn around and say, I want my portfolio. I have $1 million and I want my portfolio to pay me $50,000 a month. Well, of course you're not. You're not even going to survive 2 or 3 years. So they have to turn around and say, well, Perry, there's only so much I can do with $1 million. Because if you have a growth portfolio, you have to make sure that it grows and it continue to grow from unrealized gains into an area that until I sell it, I'm going to be making more on a per share sale. Okay. So here we go. I've now turned around, whereas before I only did like up to 20 years. I'm going to do 30 years and I'm going to show you now right down to zero meltdown, the difference between an income portfolio based on a cover call ETF that's an income representative and your growth portfolio that's represented by its underlying. Again, I'm going to warn people, this is a hypothetical. No one should or would have a portfolio with only one cover call ETF or only one stock. If you have $1 million, you wouldn't put all $1 million under HOOD and you wouldn't put all $1 million under HOOY. I'm using it as an ETF versus underlying comparison. Obviously, diversification. I'm a huge advocate of diversification. You'd be holding several cover call ETFs if you're an income portfolio believer, or you'd be holding several growth stocks in your portfolio. But at the end of the day, this is a head-to-head on one stock. So again, what I wanted to show you here is if there's no erosion at all, if there's no withdrawal, and you can look up here, this is the one that's going to actually change the numbers. So I'm turning around and say, what happens if I don't withdraw anything anymore at all? Well, obviously, and this will make the guy that basically debates me all the time say, oh, see, I proved to you it does. So what I've done here is there's two types of return on investment. The one that what's quite obviously, which basically is a per share ROI. So this is the one that's here in green. This is the one here that's in green over here. This is the per share ROI. So basically it takes how many shares you got, the share and it times its value. So basically this is a very simple number. It takes the share times its value. So its growth is basically Initially, your per share was at $60. You've held it this long, it's now $140, so you've made $79. So your ROI on a per share basis is 131%. Same thing over here. I mean, it's basically black and white. But what I've added here is something that's more important. If you've got 824 shares, okay, and they have an ROI, let's assume all eight, obviously all eight put together, you have an average ROI of a certain percentage. You're going to see these numbers change. Again, if you can see, if there's no withdrawal and I'm not selling any of my shares, and obviously I'm not buying any shares. So if I keep holding 824 shares and I'm not withdrawing any money from it, my per share ROI is going to match my net holdings ROI, which means what is the ROI of what remaining stock I have in my hand? Well, if you're not losing any, then this number and this one number will always be the same. You can see this here, 190 all the way up to here, 1390. It means basically the two will be the same. Your per share is the same as your net holdings because the number of shares has not changed. Therefore, per share versus what is remaining is the same. But now let's use something, and again, I've used the scenarios where I said, let's use the 4% rule that growth investors like using. Let's say that I'm going to withdraw 4% annually. And 4% annually is for a $50,000 investment. So we're using an initial investment of $50,000. That means for HOOY, I can buy 875 shares. And for HOOD, that means at $50,000, I could buy 824 shares. So that's the going in number of shares that both sides have. We're going to turn around and say that based on $50,000, you can withdraw $167 a month. That would be a 4% withdrawal rate. And if I do 167, you can see right here, it's 4%. Okay? Now, that's easy for HOOY to keep up because at the end of the day, HOOY is generating $2,890 to $5,000, $6,000, $4,000. So to withdraw $167 is literally a drop in the ocean for it to do it. It now uses its excess income saying, hey, well, you only used $167. I still got $2,723. I'm going to now reinvest and buy 48 more shares at the going price. So this basically makes my share count go up 48. So now instead of 875, I'm now at 922. On the other side, HOOD is the other direction. HOOD basically has to capitalize some of its shares to pay that $167 because it doesn't have any income generation. Therefore, a growth portfolio has to sell its assets in order to pay its $167 a month. Now, in this case, at a price of $160, it says I need to sell 3 shares so I can give you the $167. Obviously, I'm selling you only what you need, so I'm not giving you any excess income. Therefore, I can't buy any shares back because I don't generate income to put anything back. So basically, the 3 shares that I lost here comes off here, so now it's 821. And I'm not going to go through this over and over and over, but basically you can see it's going to slowly erode based on how many shares I need to sell at the going price to get me my $167. Over here, your ROI is always calculated. Now, you notice that no matter, I just changed it to $167 a month. And you notice that now I'm still at 147% ROI. As this one individual keeps saying is, look, but my ROI is 147%. But here's the thing that he's not taking to mind. Over the course of 1 year, he went from 824 shares down to 807 shares. He's lost 18 shares. If he's lost 18 shares, the net holding ROI has dropped from 147 to 144 because the ROI is now only on 807 versus the 824. So he now only has a net ROI holding of 144%. Okay. Now, the thing is, the number is so small that it really is not impacting anything. Even HOOD can easily survive up to 30 years at a 4% ratio. So it's keeping on growing up, even though the ROI after 30 years, if you didn't sell any shares, is still 1,390. He only basically lost, he basically is down to losing, out of the 824, he still has 674 shares left. So his net holding ROI is 1,136%, where you're like, see, there you go, Perry. But here it is again. How many of you are going to survive on $167 a month? Now, so what we're going to turn around and say, let's be a little bit more realistic. So what does it take? And this is what I would turn around and use a scenario, say, how much money can I withdraw from HOOD to the point at which by 30 years, I would have no more shares left? Okay, so I'm going to have to do a little gazintas to show you the number. So if you look at this chart over here, you could see that the blue line shows you the per share number going up. So you could see that it's going up every year. Okay, sorry. Another thing I added to this thing is I've made an assumption that this stock HOOD will go up approximately $26 every year. And again, it's very volatile. Sometimes it goes down a lot. Sometimes it goes up a ton. I came up with the number $26 per year increase based on an average over 4 years. So if somebody says you're just picking something out of the hat, I had to use some metric. The metric I used is that HOOD over the past 4 years has increased in share price by $26 every year. Again, it's the only metric I have. You guys could turn around and take this spreadsheet sometime in the future and use whatever numbers you want to make yourself believe it. But I'm using a metric based on 4 years of history. Okay, so that's the number. So that means this share price, wherever it is here, every year I add $26 to it. So basically after 30 years, making the assumption that HOOD after 30 years will be worth $904 a share. Okay, just wanted to tell you that. So what you're seeing here in blue is the per share ROI. What you're seeing in red is the net ROI based on how much holdings you have left. And you can see that even though I'm withdrawing money, HOOD is still winning the battle over its withdrawal. It's still going up. So you're not going to have an issue here. Now, I'm not even going to talk about the HOOY side because at the end of the day, if I could do the chart on the other side and have it go all the way for HOOY, this orange line would not be going down. It would actually be going up and going up really quickly. So the reason I didn't put this same chart for HOOY is because it's a lot more complex for HOOY to have the same chart, because not only do I have to estimate price changes, which are very volatile and go up in a trading box, but the other problem is that with HOOY, I'd have to also make estimates on distributions each month. And that is really, I have no clue what that number could be. But what I can assure you, is that at $167 a month or a 4% withdrawal rate, HOOY is going to have no problem. It started at $50,000 and after 1 year, it's already up at $96,000 increase. It's more than almost tripled its value because it was only withdrawing 4% and it was generating far more money each month that you could reinvest. Its share count went up from 875 to 1149. So I'm not worried about HOOY keeping up at $167. The big number you as a growth investor have to worry about is how fast am I eroding my growth portfolio so that I can live up to age 90. So let's use a number that is going to bring HOOD to its knees. Basically, get HOOD to a point where after 30 years, it finally runs out of shares. You've sold all the shares. So let's use a number. I'm going to use, say, 700 just to use it as a number. So now you can see I'm not asking it to withdraw 167. I'm saying give me out of this $50,000 investment a $700 a month withdrawal. Now, again, no problem for HOOY. HOOY is still up 172%. You can see that it's still up $85,000. So it's having no problem keeping up with a $700 monthly withdrawal. HOOD on the other side has changed dramatically. Where it was going up, you can now see an inflection point where it's now saying, I'm at a point right now, and that this is going to naturally happen by mathematical science. There's a point at which it finally says, I can't keep up. My growth of the stock value can't keep up with the number of shares being sold each time. So I'm starting to erode. And you can see that slope already happening. Now, it's saying at $700, I still do have some money left. So that's the thing. One thing you're going to see here, 700 means I'm still doing okay. Look at this. The ROI per share for HOOD still outbeats HOOY. And this is the one that he wanted to bet me on, saying, I can show you that HOOD is basically always going to beat HOOY. I'm not about always, but its ROI is always going to beat it. That wasn't the argument on the table. Even though it's eroding to nothing, its per share ROI is always going to beat HOOY because you're only based it on the shares you have remaining. You're just looking at one of your remaining 751 shares and say, yeah, but look at the ROI on my one share I have. You're not taking into account the shares that you've sold that have zero value. They have zero ROI. And that's what this number here is. You notice it's now at 134%. It's going down. This one here, on the other hand, still 133, but its ROI for net holdings is going up to 265. Now, I'm going to say, well, let's find that magic number. Let's go up to 850. Let's try that number. Okay, I'm now getting close. I'm now saying, hey, I still have money after 30 years with HOOD. I still have a few shares left. It's saying I have 59 shares left, so maybe that's not 850. Let's try 875. Okay, let's try 890. Oh, let's try 910. You see what we're going to get close. So 915. There we go. It's absolutely right. So right now, I've said, what happens if I withdraw $915 every month from HOOY or HOOD? Well, at $915 a month, assuming a $26 a year increase in price, you can now see that even though the ROI per share for HOOD is 147%, it's still beating HOOY at 133%. But look at its net ROI holdings. Basically, HOOY still has a 250% net ROI holdings on total shares held. Guess what it is over here? After 1 year, HOOD is down, is only at 130. But here's the big one. As it keeps going down and losing more and more shares, at the 30th year, you will run out of shares. So when you have no more shares left, even though, let's say you have one share. Let's assume you only have one share left. At 30 years, let's assume you have one share. Your ROI on that one share is 1,390%. But do you see the math and the failure of logic for the growth investors that says that it's all about ROI? So I've got 1,390% ROI on one share, but I have no more shares left. If I sell that one last share, I have zero ROI because I have zero stock. So this is the more important ROI. It's the ROI on your total net holdings of your entire HOOD, of your whole 824 shares when you started. You have zero shares left. So the ROI per share for HOOD doesn't matter. It was 1,390. Yeah, you beat us. But at the end of the day, you actually have zero ROI because you have no HOOD left. Now let's go over to the other side. At $915 a month, while HOOD in 30 years would run out of money, look at what's happening over here. HOOY still has a net gain of $81,000. It basically has that's a 167% gain over the $50,000 initial investment. And that is at the maximum that HOOD can actually withdraw money. If you want to actually do with HOOY what you did with HOOD and say, take me to a withdrawal rate that basically maxes out HOOY so that it actually will start eroding. And I don't know to what level of 30 years it's going to be, but you're going to start seeing that it's near zero, where it's about literally balanced. I have to take HOOY to a monthly withdrawal of $2,900. You're talking about HOOD's maximum over 30 years of $915. Well, over for HOOY, I can run at $2,900 a month withdrawal. That's a 70% withdrawal rate. Again, crazy for a $50,000 investment. I'm just saying you wouldn't want to do this. But look what happens. At the end of the day here, I'm still at $91,000. I'm still doing an 84% return on $2,900. I don't have to sell any shares. I'm getting close to the point where I cannot buy any more shares from excess, but I'm still able to even go higher. But I'm at a safe level that if I stuck at $2,900 monthly withdrawal rate for HOOY, I would be still at a 70% withdrawal rate, keeping HOOY stable for at least the first year, and it would go on if things just stay the same. HOOY is a very like volatile but staying in its trading box. So this would be what happens here. Look what happens to HOOD if you basically do this to HOOY. HOOD on its 4th year would be out of cash. Out of cash. So this, for those people that think that a growth portfolio is the best portfolio when you actually during your consumption phase, this shows you at an extreme level why it doesn't matter at what withdrawal rate you are. The point would be is under any scenario, the more efficient portfolio during consumption is the income portfolio, because no matter what you turn around and say, you could turn around and say, yeah, but Perry, I got $6 million worth of HOOD, so I can afford a $2,900 a month withdrawal because I got $6 million. Well, that's fine if you have $6 million. So if you want to run a car that gets 6 miles to the gallon, and when there's a car right beside you that for the same amount of money can basically generate, say, 30 miles to the gallon, but you're saying, yeah, but I really don't care if I'm burning all this gas. I love the growth portfolio. I like the leather seats in my car. So I'm going to stick with this car that only gets 5 miles to the gallon because I can afford all that gas. It just doesn't make sense. The more efficient portfolio, it doesn't debate the point that the most efficient portfolio during consumption is the income portfolio, because this is what happens when you push HOOY to its nth degree. You could see HOOD can't even survive 3 or 4 years. So that is what I'm trying to say. Again, the 0% ROI. So for that debater in Blossom that kept on saying my ROI beats your ROI, it doesn't matter. This per share ROI here, when you're on your 4th year and you've run out of money, yeah, my one remaining share is at 267%. Yeah, but you don't have any shares left. So you don't get any ROI on a share that you don't even own. The point is you have 0 ROI because you've sold all your shares. I can do the same scenario with coin over CONY. So I did this spreadsheet again and said, here's 30 years here. So I do the same scenario. What's the maximum that coin can tolerate before it runs out of money at 30 years? So I don't know, let's use, $500. So it's already run out of money. If I ask coin, and it's basically on a $10 per year growth rate based on since inception 5 years ago, its IPO, it's been going up about $10 a year. So that was why I used this number. It's actually wrong. The number is actually $5 up, but I've actually given it the benefit of doubt and said that coin will grow $10 a year for the next every year. I mean, if you want to use another number, that's fine. Here, I'm just going to help you out for somebody who says that's not fair. Let me give you $30. There you go. So I'd have to go up $30 every year, even though that has never shown that it could ever do it. I would have to go up $30 a year just to get me to my 30 years before I'd run out of shares. That is not the right number. It's closer to this. It's actually less than this. I would run out of money by the 19th year running here. So that's too much. So let's ask for $400. And that's not enough. So I have to actually ask coin to only take out $300. Okay, I'm close. So I'm down to 92 shares. So let's say it's 340. 360. I'm sorry, I'm just using this number here. Okay, so it's $350. So at $350 withdrawal rate for coin, that is basically saying forget the 4% rule. Coin is more aggressive. I'm allowed to basically have a withdrawal rate of 8%, and I will get you to 30 years if you only take $350 out a year, a month for the next 30 years. Coin will survive based on these projections. Okay? Well, that's fine here, but take a look at CONY. Again, this CONY, for those of you who don't know, has for the entire 2025 eroded almost 70% of its value. So I'm not giving you a cover call ETF that's healthy and kicking butt just like HOOY is. CONY has been having a lot of troubles. Its NAV at one time was in the 20s. It's now at like $5. So here's a cover call ETF that basically has been eroding for the entire 2025. And even doing that, it has still gained a 94% ROI return on. It's got a 98% ROI. Again, I know coin will be 338, but we've already talked about what that number really means. But it has gained 94% NAV over the 50,000 because it has reinvested more money back into itself in number of shares. In the time of this 2 years, CONY has basically went from 2,500 shares to owning over 10,900 shares because, of course, the lower the price of each share, the more shares it can buy from the excess income. So it's going up, again, as coin basically runs out of money at 30 years. If I actually put CONY, again, like I did with HOOY, and I say, okay, I'm going to run it at its maximum, and I already know because I calculated it, it's $1,900. I put it right here. So this is telling CONY withdraw $1,900 a month, which is about the max that CONY can take before it would actually show signs of erosion, meaning that I would actually not be able to buy any more shares, and that basically I'm actually taking out more money than I'm actually generating. At $1,900, I'm still safely generating more money. I could go up to say $2,200, but safely I can run CONY with a $1,900 withdrawal rate, which is a 46% withdrawal rate. If I did that, look what happens to coin at the same time. My net ROI after the 4th year into the 5th year, you have no more coin shares left because you had to sell them all in order to generate $1,900 a month. So once again, hands down, not even a close race. CONY basically already got to the finish line before coin basically went through the first 100 meters. So this is not even a horse race here. This is basically he was sitting there having coffee while he was waiting for coin. Coin basically died in the 5th year on the racetrack. So this shows you again, this is the metric that I'm trying to show you. When it's trying to compete against its cover call ETF that can generate income and replenish it back with reinvestment, you're not going to compete. You're just not going to compete. Okay? And then the last one I'm going to give you, because it's basically rinse and repeat, I'm going to do the same thing here with HYLD, a hedged cover call ETF with leverage, versus a growth ETF that simulates the S&P. It's hedged as well, but it does not use leverage. This is a very apples to apples type comparison to HYLD's underlying. So here it is. Everything looks good. Now, actually, this is a neat scenario because VSP does actually generate dividends. So you can see over here, every quarter, it's generating some dividends. So where you can actually see before that the blue line and the red line were the same with no withdrawals, you're actually showing here that VSP is actually going up, versus the per share net. It's actually rising because every quarter it gets to reinvest or basically not have to sell as many of its shares. It can actually reinvest them because you're asking it not to withdraw anything. So when there's no withdrawal on a monthly basis, VSP is rising slowly because it could reinvest its dividends, and that's why it's very slowly rising. So you can see the net ROI, it's going to be a little bit better than its per share ROI, obviously, because you actually have more shares with that ROI. So its ROI is 46%. HYLD, in this case, beats VSP because it not only does it not only has, I guess, maybe a better underlying, but it also has leverage, which the VSP doesn't have leverage, and that is why HYLD is beating VSP even in the growth only portfolio stage where there's no withdrawals. 46 versus 56, right? And you could see also its net ROI is higher because there's more income being generated by HYLD that could be reinvested. So its net ROI is at 72%, where this one here is only 47. If I turn around and do the same thing here and say, okay, so what does it take for VSP to run out of money on its 30th year? Let's use $200 to start. Okay, $200 is not enough. So let's say 270. Too much. So let's say 260. Okay, so basically here, 260. On the 30th year, if you ask VSP every year to give me $260 a month for the rest of the next 30 years of its life, even though I gave it, and this is a $17, this is an average over 5 years of its growth over the last 5 years. So even with a $17 average growth per year, it would say that generally all things being equal, in the 30th year, you would run out of VSP shares. You would have sold all your VSP shares to pay this $260 a month. HYLD, on the other hand, just like all the other scenarios, it doesn't matter if you're rock stars, it doesn't matter if you're an ETF eroder, a NAV eroder, or if you're a very conservative one like HYLD, it's basically, even at $260 withdrawal, it's still up 47%. It's made $23,000 over the initial $50,000 because on its first year, and it would likely continue doing that at this rate. In order for HYLD to reach its max, you would have to put it to around $500 to say HYLD is now at a point where it's sort of saying, hey, I might not be able to be sustainable after this number. This would be the latest sustainable number. You can see that it basically has only 4%, but it has not yet had any withdrawals that forced it to sell. Okay, but if I asked HYLD to pay me out $500 a month, which is a 12% withdrawal rate, VSP cannot keep up. VSP basically in the 10th year, even though it has a 227% ROI at the 10th year, again, that oh my God, ROI is the one that counts. Its net ROI is 0 on the 10th year. And that is, again, because you have 0 ROI when you own 0 stock. You can't say it more clearly than that to the growth only purists that keep saying ROI is what matters. You are right. ROI is what matters. And at the end of the day, when I'm consuming $500 a month, modest for HYLD, VSP basically has sold all its shares and has 0% ROI. It has no shares left, and 0 times 0 is 0. Doesn't matter what the number is. All right. So I'm hoping that's it. I don't want to make any further on this one because I know I always have 1-hour videos. I'm just going to go back to my thing here. I'm hoping this helps answer some more questions, and it makes it clear, even though I know I will never convince those purists in Blossom that will always stick that growth is the winner in every scenario. But for those that are wondering if he's telling the truth or I'm telling the truth, I don't know what more facts I can give you than this. This tells it indefinitely that when you are in a FIRE retirement, say at 45, forget about 30 years. You need a portfolio that's going to last 60 years or 50 or 60 years. Do you want to use a growth portfolio that has no choice but to sell its shares every day or every month? Or do you want an income portfolio that actually generates income and pays from its income as opposed to having to sell its shares? Again, I think that's about it. I hope you enjoyed this video segment. And until next time, stay safe, stay investing, and I'll see you in the PIIverse.